How is everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door, your host, Dr. Joe Berquist. I hope everyone's doing great on this Friday night. Not the best day in the world. All kinds of craziness happening out there. Obviously, tariff news. I guess depending on how you look at it, was either really good or really bad. I happen to think it was bad, not the end of the world, but bad. We also had kind of a flop with the GDP numbers. We also had a little bit of bad inflation news with the PCE index, but I don't think that's anywhere near as bad as maybe what the headline read, and I'll explain that later when we kind of get into those numbers. But a lot to talk about tonight. Private credit issues, Blue Owl having all kinds of issues with one of their funds, seeing a ton of money go out the door. Them basically said, "All right, no, we're not gonna let anybody take any more money out." Reigniting a lot of concerns in the so-called private credit market. We're going to see we got tons of Epstein fallout. I have a lot of banking news for things coming up tonight. Also, one of the big things being discussed this week was the possible changes to bank capital rules. So we're going to take a look at that a little bit later in the evening, but we're going to start off tonight, as we always do, taking a look at the debt clock. So U.S. national debt still sitting in at $38.7 trillion. That is a debt per citizen of 112,000 and a debt per taxpayer of 355,000. U.S. federal spending is officially a little over $7 trillion, and the U.S. federal budget deficit is still sitting at 1.7 trillion. We're going to take a look at an article here in just a second. We're going to look at the federal debt in 5 charts. Get an interesting look at this. Is again, because what we're looking here is at federal debt, the federal debt, the national debt, but we're going to look at all the other debt, consumer debt. We're going to take a look at how that is versus GDP. So we're sitting here with a debt to GDP right now is at 124% on the federal debt. The interest on the debt is currently $989 billion to service that. Now, what's interesting here for the moment is they have tariff revenue up to $374 billion. Well, with the rulings today, we'll have to see what happens to that. I think there's a lot of while a lot of people were cheering the news at the moment, and like I said, we'll get to that here in just a few minutes. I don't know that it's going to work out the way that they think it's going to work out, and we'll see. We'll talk. Like I said, we'll talk about that in a minute. But first, so I wanted to show. I thought this article was really interesting, and this was from the Wall Street Journal, and this was why the federal deficit is projected to surge in 5 charts. U.S. debt will be more than 100% of U.S. gross domestic product by later this year, according to the CBO projections. Now, I will make this a little bit bigger here so that everybody can see this. So the CBO projects that the annual U.S. budget deficit will top $3 trillion by fiscal year 2036. The deficit was briefly that high when the federal government spent heavily during the COVID-19 pandemic. So we could see from this chart here that the federal budget deficit did get to a little over $3 trillion in, what was that, 2020, and then in 2021 it was probably about 2.7 trillion, and that got brought down to a little over about 1.3, and then has climbed back up, like I said, to about 1.7 right now. But you can see here in the coming years, I mean, that's just projected to grow larger and larger and larger, mainly because of what I have talked about for the last few years, and that is Congress, just for whatever reason, has no appetite whatsoever to cut spending or even attempt to get the spending under control, which is pretty wild. And that was one of my predictions going into last year, into 2025. I said people in January of 2025, when Donald Trump was first going in, and everybody was saying, oh, the Republicans have the House and they have the Senate and they got the presidency, and they're going to get all this stuff done and all these things are going to happen. They're going to cut all this spending or whatever. And I kind of chuckled in a way, because I said, yeah, people are in for a big shock. They're in for a big shock because they're going to find out that the vast majority of Republicans basically have no stomach, no desire whatsoever to cut one dime of federal spending, not one dime. And where are we at here? Where they've barely made a dent. They killed Doge so fast. They wanted Doge out of there in the worst way. So, but let's look at some other things here. So by fiscal year 2036, the deficit will hit 6.7% of GDP, up from 5.8% in 2025. So they're basically saying the annual deficit as a percentage of GDP will continue to increase there. Social Security and Medicare costs will drive mandatory spending to 15% of GDP by fiscal year 2036. Mounting debt will increase spending on net interest to nearly 5% of GDP. So you can see here just the mandatory spending looking to go up right now from about 13% up to 15%. Just so the discretionary spending is going to decrease and the net interest on the national debt is going to go up. So yes, that's to be expected. As basically as the pie shrinks, as the national debt grows, and we have to spend more money on interest just to service that national debt every year. This is going to happen. Your mandatory spend is going to go up. CBO projects a 23 trillion deficit from 2026 to 2035, up around 1.4 trillion from its latest projection. Tariff revenue will only partly offset effects of the GOP's One Big Beautiful tax law. And so it comes in here basically deficit projection in the trillions. So 21.5 in January 2025, February of 2026. Up to 23.1, and that little extra couple $1 trillion is the 2025 Reconciliation Act and other legislative changes, higher interest rates and other economic changes, increased tariff rates and other technical changes. They have here is at a negative $2.7 trillion, which is very interesting why they would have that as negative. And then we go down to debt held by the public will surpass 100% of GDP this year and is projected to exceed 120% by fiscal year 2036. Now, this is the thing that to me is perhaps the most concerning. These other numbers, when you go up and look at these other charts, a lot of this stuff over the next 10 years, like this can really be manipulated. And it really depends on what does Congress really want to do? I mean, if Congress does their job and they reduce spending, they really crack down on fraud, and they begin to put money into the economy in the right way in terms of really getting the economy going, really getting the economy booming, that could dramatically alter a lot of these numbers. Right here, like the mandatory spend, all this here, this could all dramatically change. The deficit hitting 6.7% of GDP. Again, this stuff could all change. And, but this, like I said, is the most concerning because as we go back to this chart here for a second, we see that the federal debt is currently at 124% debt to GDP right now today. That's where the federal debt is. Now, this is on, again, like consumer debt. Debt held by the public. So this is, in other words, this is your mortgages, your student loans, your credit cards, your auto loans, personal loans, all that fun stuff is all projected in here. We're hovering around 100% of debt to GDP right now, but then they're saying that could shoot up to 120% here in the next 10 years. So, and that is highly troubling. So just some like I said, I really liked a lot of these charts. I thought they were very interesting. I wanted to point them out, but this gets back to it doesn't. I think President Trump is doing a great job in terms of the economy, and we see that in just a lot of things that are happening. The growth in the GDP, the growth in jobs in terms of native citizens, how the foreign-born citizens and the jobs numbers for them are decreasing, and for the native citizens, those numbers are increasing. The GDP is going good. Inflation has gotten under. I'm not going to say it's great, but it's gotten under control. I think he's trying to do everything he can with the trade. He's brought a tremendous amount of trade revenue in with the tariffs, and but despite that, you still, it doesn't matter in a certain respect who the president is or what the president is doing if Congress does not want to do their part in this. If the Federal Reserve does not want to do their part in this, it makes it, I mean, it makes it very, very difficult to get, all of this stuff under control and really make something magical happen here. A lot of these problems could be fixed. They could be fixed if Congress would do their job, if the Federal Reserve would do their job. If you had somebody who was not political running the Fed right now and was just making decisions based on what was best for the economy, then we'd be in better shape, and things would be going a lot better than they are right now. But that's not the case now. All right, I want to switch to something here. I just wanted to show this briefly. Again, this is just kind of a refresher on the repo market. Now, going back probably about a couple months, I opened up one of the live streams here, and I did a whole segment. I had probably did about 20 or 30 minutes just on the repo market. And I probably showed about 6 or 7 different charts, talked extensively about how the repo market is at the center of the liquidity for the market itself. And I showed the Federal Reserve's balance sheet and how there's a direct correlation between the reduction in the Fed's balance sheet and the reduction of the liquidity here in the repo market. And you can see that we are down to next to nothing here in the repo market. And then I want to show you this chart here. So this chart is basically showing these liquidity spikes, if you will, in the repo market. Now, things have been pretty quiet to start the year. Not really, as you can see here. I mean, this last big spike that we had here was January 2nd, which was 19.5 billion got interjected into the repo market. And then after that, things really calmed down and got kind of quiet. But then a couple days ago, we had another massive injection of 18.5 billion, another big spike here with a massive injection. So, and I just wanted to point this out because as I talked about this a lot, I saw this happening from October, November, December last year, and I pointed this out a lot. And like I said, it's been relatively quiet here the last 6 weeks or so. Not really too much action until this week. And I just wanted to point out that there is still a liquidity issue in the market, and we're still going to see these liquidity spikes in here because this also plays into how much money the Federal Reserve is pumping into the economy. Like, in other words, I think at the December meeting, the Fed basically said, okay, we're going to go back in and we're going to start buying again. We're not doing quantitative easing, even though that's basically what they're doing. They're like, we're going to go in, we're going to start buying another 40 billion of bonds every month. But I believe with this liquidity injection, I believe their spending is actually 70 billion. Over the last month. So again, and I just point that out. I'm not trying to be overly critical or anything of the Fed. I'm just basically trying to point out what that this is an issue. Having basically next to no liquidity in the repo market, you're going to get these liquidity spikes, and we're going to continue to get these until you start to see repo market activity pick back up here, which again is why the Fed is back in buying to basically get this back up. So we'll keep an eye on that, and we shall see what happens. So, all right, let's take a glance in on interest rates here for just a second. So we can see here 10-year note right now at 4.091%. So the 10-year not doing too bad, basically right around where we want it to be. Did surprisingly with all the news today, I want to go back here for a second. Surprisingly with all the news today, didn't see any dramatic crazy change. I mean, it did bounce back up this morning a little bit to, if I could peg on this here. Yeah, it did bounce up to a little bit, just a hair over 4.1, but then came down throughout the rest of the day. So again, nothing really too crazy here happening with interest rates. 30-year bond still holding where it was. 7-year, 2-year still at like 3.482%. So nothing really crazy, no real crazy movements in the bond yields. Let's look at mortgage rates. So current mortgage rates. So here are the current mortgage rates as of today, February 20th. The 30-year fixed rate is at 5.81%. 20-year fixed is at 5.81, and the 15-year fixed is at 5.35%. The 5/1 ARM is at 5.86. So again, interest rates really coming down, and I wonder if there's a note on here. Yeah, the average 30-year fixed rate fell 8 basis points to 6.01%. The 15-year fixed rate dropped 9 basis points to 5.35. With rates falling, purchases and refinance demand will grow. So again, that's really good. I mean, mortgage rates really starting to come into an area where we should see demand begin to pick up here. We should see this. All right, now let's get into our big story here. So obviously today, kind of the shocking news, if you will, seeing the Supreme Court strike down President Trump's tariffs, rebuking the president's signature economic policy. So the Supreme Court struck down a huge chunk of President Donald Trump's far-reaching tariff agenda. The law that undergirds those import duties does not authorize the president to impose tariffs. The majority ruled 6-3. Chief Justice John Roberts delivered the opinion of the court. Justices Clarence Thomas, Samuel Alito, and Brett Kavanaugh dissented. The Supreme Court on Friday struck down a huge chunk of President Donald Trump's far-reaching tariff agenda, delivering a major rebuke of the president's key economic policy. The law that undergirds those import duties does not authorize the president to impose tariffs. The majority ruled 6-3 in the long-awaited decision. The ruling is a massive loss for Trump, who had made tariffs and his asserted power to impose them on any country at any time without congressional input a central figure of his second presidential term. Trump's legal stance would represent a transformative expansion of the president's authority over tariff policy, the majority concluded. And they highlighted that Trump imposed the tariffs without Congress, which has the power to tax under the Constitution. Chief Justice John Roberts delivered the opinion of the court. Justices Clarence Thomas, Samuel Alito, and Brett Kavanaugh dissented. Now, let's take a look at some other things here. So again, it was a lot of drama today. So after this dissent came out, or after the ruling came out, but there were some very interesting things in the ruling itself, and what we have to understand what we're talking about here, and that is, I want to see here. I want to jump over to this. Okay, so the law that the Supreme Court was really looking at was called the International Emergency Economic Powers Act, also known as the IEEPA. Now, one of the interesting things here in this ruling is that Trump already has a number of other tariff laws that already exist. There's three, four, five other tariff laws that are already out there that he can already use to his advantage here. So I think for all the people cheering this decision, I don't think that, again, I wouldn't jump to thinking that this was cheers or whatever. But what I don't understand, and what really drives me crazy is that how, the people cheering this thing is kind of wild, because this is a win for the big corporations. This is a win for other countries. China had to just be laughing at us. China had to just be laughing at us. They had to be sitting there going, "Oh, the Americans are so stupid." Like, how do they, how do they do this? They're shafting themselves. How do they, it's just why I think if I'm China, I'm just sitting there just laughing today, going, my gosh, these guys are so dumb. They just kneecap themselves every time. So again, I wouldn't be so quick to cheer this on, because again, this was really working. And as we're going to see here in a second, when we look at some of these other articles, the question now, which, again, a lot of these countries and companies are going to want tariffs to be refunded. And there's a big chunk that may yet happen. But the question is, there's going to be legal fights in courts that are going to, and like I said, we'll look at this in a second, this article, but there's going to be legal fights in courts. This could drag out for years and years and years. This could drag out well past, President Trump being in office. So this could get really interesting. And so, but let's take a step back. So they make the decision. Then Trump comes out. He does a press conference. And Trump basically announces a new 10% global tariff after raging over Supreme Court decision. So President Donald Trump said he will sign an executive order imposing a new 10% global tariff under Section 122 of the Trade Act of 1974. And like I just said, he has these other 3, 4, 5 trade laws at his disposal that he can utilize. They only went after one, which again it was partially tried to be used as like a national security thing. Now, these other acts, and I believe this Section 122 that he is taking advantage of, the Trade Act of 1974, I believe that is specifically around national security. So if Trump basically says, hey, this is a matter of national security, which in a very real sense, these tariffs are a matter of national security. These are protecting our industrial base, they're protecting industries and jobs, protecting logistics. I mean, we've already got the issue with a lot of medicine where we can't make them. We found out during the pandemic, we can't make a lot of the medicine that, basic stuff, we can't make it because the key ingredients are made over in China, and China knows that. And so one of the things that Trump is trying to do is to try to get those logistics back here so that we're not at the mercy of China with a lot of this stuff. And why some people can't seem to figure that out is kind of beyond me. But so President Trump says he's putting in place this 10%, this new global tariff. Trump was defiant following a major Supreme Court defeat, saying he will find other ways to impose global tariffs that were struck down. Trump's remarks vacillated between defiant and scathing. He even went after Justices Neil Gorsuch and Amy Coney Barrett, whom he nominated after they voted with the majority in the 6-3 tariff ruling. President Donald Trump said Friday he will sign an executive order imposing a new 10% global tariff hours after the Supreme Court struck down his sweeping reciprocal import duties in a major rebuke of his trade agenda. The new Section 122 tariffs will come on top of the levies that remain intact following the High Court's decision, Trump said as he raged at the deeply disappointing ruling during the White House press briefing. I'm ashamed of certain members of the court, absolutely ashamed for not having the courage to do what's right for our country. The court's ruling invalidated the legal underpinnings of many of the tariffs that Trump insisted are essential for the U.S. economy and for rebuilding America's shrinking manufacturing base. The justices struck down the tariffs Trump had imposed using the International Emergencies Economic Powers Act, or the IEEPA. Trump's reciprocal tariffs and his drug trafficking related tariffs both hinged on that law. The majority ruled Friday that IEEPA does not authorize the president to impose tariffs. The newly proposed 10% tariffs, which come with a 150-day time limit, will effectively replace the IEEPA duties. The White House official told CNBC later Friday that could mean lower U.S. tariff rates for some of the countries that had either struck trade deals with the Trump administration or were in ongoing trade talks. That's because many of those countries and regions had faced U.S. tariffs higher than 10% as part of those agreements. The European Union, for example, agreed to a 15% tariff as part of its trade deal with the U.S. Those tariffs were largely implemented under the IEEPA, meaning they were invalidated as a result of the Supreme Court's ruling. The shakeup could be significant for China, which faced 2 sets of 10% IEEPA-based U.S. tariffs, in addition to a 25% duty that remains in effect. Those IEEPA tariffs will be replaced by Trump's new global tariff, bringing China's total rate of 35% to basically to 35%, the White House official told CNBC. Trump was adamant that he will find other ways to impose tariffs without Congress. And the White House official noted that as the administration works through additional legal tariff pathways, the rates imposed on individual countries may snap back to their higher levels. Here's one. Before I go on to the next article here, I just want to say this. So there was a couple things, and I saw a lot of posts online about this today. So there's a lot of things that were evident in basically the opinion that came out here from the Supreme Court. Number one was that I thought the dissenting opinions from Thomas and from Kavanaugh and Alito, I thought they were spot on. I thought they were absolutely spot on with their comment. They basically said, like, yeah, I mean, the Trump, the president has the ability to do this. And it was rather, it was rather shocking that, you had Roberts and Amy Coney Barrett and Gorsuch. I mean, basically, their opinions were really, not well founded. I mean, when you really go back, when you read the opinions, not well founded. A lot of almost seemingly like gobbledygook that they came back with, and and again, and what is one of the other, but the one of the interesting things that I noticed and what came out of this is that there could potentially be basically a back door here for Trump. And that is what we're seeing here with this Section 122 of the Trade Act of 1974. And that is that the Supreme Court shot down this one law, the IEEPA. But what they basically said is that, hey, we said you couldn't do it with this, but we're not saying that you can't do it with these other ones. So my guess is Trump is going to go after some of these other acts and these other laws that are already out there. They're already established. He's going to use those. And when those come back to the Supreme Court, he's probably going to get a more favorable ruling because those it will be under different circumstances. And one of the things I will say here, too, is that I think Trump's team did a lousy job. I listened to, I would say, probably a little over half of the oral arguments when his team was in there arguing this before the Supreme Court. And I just felt like, but my takeaway was, I felt like his team, the lawyers, I felt like they did a horrible job of presenting their case here. I thought that they really let the president down, and they really did a bad job of presenting this and trying to make their points. And it's just, they just didn't do a good job. They just flat out didn't do a good job. And I think because they didn't do a good job, that left this open for the justices to come back with the decision that they did today here. So, all right, but let's look at a couple other things here. So the Supreme Court, they made this decision now. So this could put the U.S. on the hook for $175 billion in refunds, the estimate says. So the U.S. government could owe more than $175 billion in refunds to importers after the Supreme Court ruled in a 6-3 decision that tariffs unilaterally imposed by President Trump are illegal. The new estimate says, I don't know that they really ruled that they're illegal. I think they basically just said he couldn't do it under that law. The potential refunds to a broad range of companies would be for tariffs already collected by the government since Trump slapped on the duties without authorization from Congress. The $175 billion refund estimate from the Penn-Wharton budget model was produced at the request of Reuters. The model is a nonpartisan fiscal research group at the University of I'm sorry, nonpartisan. Reuters, Penn, nonpartisan. That's funny. These guys, they're not without a sense of humor. They're not without a sense of humor. So this model basically saying that we could be on the U.S. could be on the hook for $175 billion. Look, I'm just going to say it right now. I don't think these companies are getting any of this money back. They can have wishful thinking. I think was this we got here. So let me say this before I finish that thought there. So Supreme Court Trump tariff decision impacts, like what to expect as the fight for the billions in refunds begins. So the ruling did not clearly grant refund payments. And President Trump said on Friday afternoon that a court fight over refunds could take years. And he announced a new 10% global tariff would be implemented. So importers have also laid out billions for bonds and collateral required by U.S. Customs and Border Protection to guarantee payments of trade duties. In his dissent, Justice Brett Kavanaugh noted the ruling lacked any refund guidance, and he referred to comments during the oral arguments that the refund process may be a mess. Yes, this is in fact one of the side effects that I had talked about going back, a month or so, and that was I really sat here and I said, and I think it is egregious. I agree with President Trump. I agree with his anger here. I'm upset at the Supreme Court for them ruling the way they did on this, because I think it is egregious, because I said, number one, it really has thrown the president's signature tariff policy here. It's thrown that into chaos. It has now created this potential mess of, do these companies get this money back? Don't they? Because as Brett Kavanaugh just pointed out, that in his dissent, that basically there's nothing in there that says, okay, now you have to give the money back, or how you get the money back, or who gets the money back, or how much, or whatever. And do they get back all of it, part of it, whatever? There's nothing in there that addresses that. So now you've completely thrown this into chaos. And like you said, I mean, Trump, I think, will find a way to still get these done. But the other thing is that, the easiest solution here would be for him to just go back to Congress and have Congress just codify this by basically passing a law and saying, yeah, Trump can do this. But they won't do that. Congress won't do that because these guys are too busy. They're too busy selling us out for the most part to basically do something to stand up for us. Which is just a travesty. So Trump is out there, left to do this on his own. But the other crazy thing is that, again, and I said it in my argument, I said it's not about Trump per se. This is about the presidency. It's about the office of the presidency. It's about, you are kneecapping not only Trump here, but in a very real way, you are kneecapping any future president. So any future president that comes in and says, oh, hey, I need to, hey man, I got to protect these industries, or I have to protect the military, or I need to be able to protect that, we could still develop and build the ammunition, the missiles, the bullets, like everything, the Kevlar vests. I mean, the armor for all the things that we need to be able to produce all that. And the president goes, man, I got to protect this. I got to protect the companies that are involved, and the logistics and the supply chains. And I might need tariffs to do that. And it's, oh, sorry, sorry, you can't do that. We're not going to allow you to put those tariffs on. So, and basically, I mean, it's just so ridiculous, because it's like basically any other country around the world, the EU, China, Russia, I mean, they can do this to us, no problem, nothing to stop them from doing this to us. But heaven forbid we do it to them, or we are able to kind of fight fire with fire, so to speak. That, again, it's just, that's why, to me, this decision was so irresponsible on their part. And again, who knows, maybe in 6 months or a year, this rolls back around. Maybe, like I said, maybe Trump uses some of these other things at his disposal, and it rolls back around, and then next time they go, oh yeah, that's fine, you could do it this way, whatever. But like I said, in the meantime, though, they cause a massive amount of just chaos and uncertainty around this whole thing, which I just think is just ridiculous that they did this. So all right, let's go here. So now you had all these clowns, parading around today. The U.S. trading partners cheer the Supreme Court tariff ruling, but businesses must still navigate murky waters. Lawmakers in the EU and the UK and Canada are reacting to the U.S. Supreme Court's ruling against President Donald Trump's far-reaching tariffs. Yeah, I mean, they're sitting there licking their chops going, oh, this is great. We could go back to getting one over on the U.S. We can go back to shafting the U.S. This is fantastic. It's ridiculous. It's ridiculous. And all these clowns could sit there and they could all clap and be all happy. Yeah, you have your moment. Have your moment for 5 seconds, because it's not going to last long. It's not going to last long. But let's look at a couple of other interesting things here. So U.S. businesses shift away from China under the Trump tariffs. So JP Morgan Chase Institute finds that mid-sized firms are shifting payments to Southeast Asia, Japan, and India as China tariffs reach 37.4%. So a new analysis found that payments made by the U.S.-based mid-sized businesses to firms in China dropped significantly last year as tariffs on Chinese imports rose under the Trump administration. JP Morgan Chase Institutes, I don't know why that stupid ad popped up there and why I can't seem to get rid of it. All right, but anyway. But the report found that among mid-sized firms that had prior outflows to China, their outflows to other parts of Asia grew, including Southeast Asia, Japan, and India when looking at a sample of mid-sized firms with at least 5,000 in outflows to China in both 23 and 24. One potential reason for the increase in flows to these countries might be import substitutions, but many other explanations are possible, the authors noted. So, and then we have a dismal China exports add to freight trade slump for the nation's biggest port. So, the port of Los Angeles, the nation's largest port, saw total cargo volumes drop 12% in January year over year, with the port's executive director, Gene Soroka, citing dismal exports to China as a prominent factor. Imports were down roughly 13% year over year in January, typically a period of increasing freight ahead of the Lunar New Year holiday in China and other Asian manufacturing nations. Soroka said it is important to note import comparisons are being made to elevated levels in 2025 as freight trade was front loaded ahead of tariffs, but the port's overall activity was the lowest monthly output in almost 3 years. So again, there you can see there a port of Los Angeles there, the nation's largest port. So again, these exports, to China are basically down here. So again, this was part of this was supposed to happen. This was like all part of the plan. Basically, this was a big part of what was supposed to happen here. So basically, and a lot of the product, if you will, the inventory has been moving around the world. A lot of Chinese goods they have been shipping over to the EU, and the EU is basically crying right now, telling China, okay, stop shipping your stuff over here because we have this giant glut of product here, and we can't move this stuff, we can't sell it, and so again, China's trying to keep their numbers up, keep their numbers looking good by basically pushing all the excess over to the EU that they haven't been pushing over here. So let's look at, so now the U.S. trade deficit totaled $901 billion in 2025, barely budging despite Trump's tariffs. So for the full year, the U.S. ran a $901 billion trade deficit, down slightly from 2024, but only by 0.2% or $2.1 billion. The report follows a year in which President Donald Trump implemented a series of aggressive tariffs aimed at leveling the global playing field. So the U.S. trade deficit swelled in December, closing out a year in which the imbalance was essentially unchanged, despite efforts by the Trump administration to close the wide gap. Closing out a tumultuous year in the global marketplace, the goods and services shortfall in December totaled $70.3 billion, the Commerce Department reported Thursday. That marked an increase of $17.3 billion from November and was well above the Dow Jones consensus estimate of $55.5 billion. For the full year, the U.S. ran a $901.5 billion deficit, down slightly from 2024, but only a little bit, or only down about $2.1 billion. The total was also a bit less than the record $923.7 billion shortfall in 2022. The report follows a year in which President Donald Trump implemented a series of aggressive tariffs aimed at leveling the global playing field. In April, Trump announced a cross-the-border duty of 10% on all imports, as well as so-called reciprocal tariffs aimed at specific countries that had run-up surpluses against the U.S. Again, not a real massive change, even though we had seen the trade deficit getting reduced over the last 6 months. We had seen it. We had, as per some of the numbers I just read there, it had been down, but then it jumped back up a little bit in December. But again, I think what's interesting here is that if Trump, I think here's one of the things you have to think of. You have to look at it from the other side of the coin. If Trump hadn't done the things that he would have done, this would have been the trade deficit would have been well over $1 trillion. It would have probably been 1.1, 1.2, maybe even 1.25 trillion. So again, I think if you look at it from that perspective and you say, well, if Trump hadn't done the things he had done, this trade deficit would have been far, far worse. But what he did do, again, it maybe didn't get as much of a reduction as you were hoping for or looking for, but it certainly got just a hair better. Certainly didn't get any worse. And I think that if things would have kept going the way that they should have, I think you would have seen this continue to come back down. Again, maybe not with any kind of like a major reduction. Like in other words, it's not like it would have got like cut in half, but I think it would have. I think over gradually over time here, over the next year or two, I think you probably would have seen that started to whittle down to 700 billion, 600 billion, something like that. But you know, again, with this kind of with the tariffs, at least for the moment, being thrown into a little bit of chaos, we don't really know how this is going to completely shake out here now over, you know, say the next 6 months or so. Um, my I'll get to this story in a second. My guess is that basically this is gonna stay about normal. It's just gonna stay about normal here for the next, you know, 6 months until we see kind of what happens with these tariffs, because this is now because again, Trump, he kind of like again, I always thought, I'll put it this way, I always thought the plan with the tariffs was this: Trump was going to come out with kind of a shock, that was like Liberation Day last April. He was going to come out with like a kind of a shock and awe campaign, right? He's going to hit everybody with tariffs, and then he was going to methodically go around and basically work everybody for better trade deals, which is what he did, knowing that the last one was always going to be China. China was always going to be the last one. And he had gotten to a point here where he had gotten basically all of the other, he'd gotten the EU and, you know, still talking to Russia with a lot of stuff, but he'd gotten the EU. He was working on stuff with Argentina and Venezuela and Brazil. And, you know, he was getting, you know, he's still working with India a little bit, you know, but he'd gotten something worked out with Japan and working with, you know, South Korea. So there was a lot of really good things that had happened. A lot of good trade deals and everything were already in place. And then it was again, he's got this meeting with Xi that's coming up here. And I believe that he was going to then begin to pivot toward China and really try to make a dent in this. But now with this ruling from the Supreme Court, that's probably that's probably undoubtedly going to push that whole timetable back. So my guess is Trump will still play, you know, he'll still play hardball with China, but he's gonna probably back off a little bit now. He's probably gonna back off until they could kind of figure out or at least begin to implement whatever Plan B or Plan C is in terms of the tariffs to try to figure that out. So, all right, that's kind of my thoughts on there. All right, let's take a look at this for a second. So, Kevin Hassett got really fired up this week. He got really upset because Hassett says authors of New York Fed tariffs study should be disciplined. Worst paper I have ever seen. So White House economic advisor Kevin Hassett said Wednesday that the authors of a New York Fed paper that found U.S. companies and consumers are shouldering most of the tariff burden should be disciplined. Yes, I think the worst paper I've seen in the history of the Federal Reserve System, he said. The paper in question concluded that 90% of the tariff burden is being shouldered domestically. So in a CNBC interview, the National Economic Council director ripped the report, saying that central bank researchers ignored key aspects of how the duties worked and instead simply focused on prices. Hassett said the research also should have included the upward impact on wages and benefits that U.S. companies see by bringing more production onshore. I mean, the paper is an embarrassment, Hassett said during the Squawk Box interview. It's I think, the worst paper I've ever seen in the history of the Federal Reserve. The people associated with this paper should presumably be disciplined because what they've done is they've put out a conclusion which has created a lot of news that's highly partisan based on analysis that wouldn't be accepted in a first semester econ class. The paper in question was published on February 12th on the New York Fed's website. Here's the paper right here. We'll get to that in just a second here. Essentially, the researchers looked at whether countries that export products to the U.S. were lowering their prices or, in effect, eating the tariffs or raising their prices and passing them on to consumers and companies. The paper found that some 90% of the added costs from tariffs were being passed on, though it noted that the impact waned slightly as the year progressed. However, Hassett insisted that the tariffs had little impact on prices and were responsible for a better standard of living. Prices have gone down. Inflation is down over time. Import prices dropped a lot in the first half of the year, and that leveled off. The real wages were up $1,400 on average last year, which means that consumers were made better off by the tariffs, he said. So consumers couldn't have been made better off by the tariffs. If this New York Fed analysis was correct, it's really just an embarrassment. I can't imagine who signed off on it. So here is the paper in question. This is from the Federal Reserve Bank of New York. And this basically was published on February 12th, and this is called Who is Paying for the 2025 U.S. Tariffs? And this was written by Mary Amity, Chris Flanagan, Sebastian Hees, and David E. Weinstein. Now, again, they just focused on prices. The average tariff rate has increased. Well, yeah, of course it has. Yeah, of course it has. But again, and it gets down here, and again, this thing is really short, so it shows in here like tariff share of U.S. imports has fallen markedly. We just talked about that a second ago. Who bears the costs of tariffs? Tariff incident falls mostly on U.S. importers, and then that's it. Like this, so this is, I mean, to call this a paper, it's really more. It's really. I mean, if this is a paper, it's like a 5-page paper. It's not. It's not. This is not like some real in-depth research analysis here. But for the what I would call the drive-by media, this served the purpose. They wanted. I'm sure they called up the Fed and said, "Hey, we need something that basically says that these tariffs are getting all passed on to the consumer." So these guys, put out this really shoddy research paper here, and then boom, then the media immediately, jumps all over it. It's like, "Oh, look here, here's the proof, here's the proof." And first of all, I covered. In an episode, I covered that the San Francisco Federal Reserve Bank just put out a paper on the tariffs, and I've talked about this the last couple of weeks here. What were their conclusions in the paper? The conclusions were two main things. Number one, that tariffs are not inflationary; they are actually deflationary, and they are deflationary because they reduce economic activity in the economy. So the activity goes down. Prices go down, and therefore making the tariffs deflationary. Tariffs also have a tendency, the second conclusion was that the tariffs have a tendency to increase unemployment, which makes sense because if they're reducing economic activity and you're seeing prices come down, that means they're probably also leading into a weakening in the labor market, which means a reduction in the labor force, where people getting laid off, unemployment rate rises. So that all jives. That all makes sense. This is basically, like I said, just looking at prices and saying, "Oh yeah, well this, we're looking at the prices stuff. The average tariff went up, and so this is all getting passed on to the consumer." But then the funny thing is that I think I have the no, I thought I had one other thing in here, but anyway, what is interesting is that, I've seen all these articles, and I've had a few on here the last few weeks where I've talked about how, people just griping about, all these companies griping, we're eating all the tariff money, and, this is costing us a fortune, and this, that, and the other, we can't pass it on to the consumer. So, so which is it? Is all these, is all the tariff costs getting passed to the consumer, or are the companies eating it? I haven't seen these dramatic increase in prices on, a lot of your, TVs and, clothing, TVs, everything from, barbecues, microwaves, all like any of this kind of consumer products, right? I haven't seen these massive price increases. I mean, yeah, the price of food still has some issues there, for as far as inflation goes, but not the necessarily the products itself. So that leads me to believe that, and with all the other news and everything I've covered, that no, these companies are eating the tariffs. These prices are not getting passed on to the consumer, because a lot of these companies have already figured out that the consumer is not going to be able to absorb these prices. And if you try to push those costs onto the consumer is probably going to get mad and just stop buying your product altogether. And they don't want to do that. So again, I think, Kevin Hassett, basically, speaking his mind here, obviously on this one, But yeah, no doubt this was a, what appears to be a rather shoddy paper on their part, and served the purpose. They wanted, the media wanted something to jump on, and they gave them their threw them their chum, so to speak. So all right, let's take a look at the other two things that we had here today. Obviously, the tariffs were the big ones, but then we had this big miss in fourth quarter U.S. GDP, and then we also had the PCE, the Fed's preferred inflation index, basically came in at 3% in December. Now, I would say that I don't think that 3% is really that big of a deal, and I'll tell you why. I mean, this report was one of those. Again, these are numbers for December, not January. So those numbers were, and if you remember some of the other numbers that we got for January or for December, the CPI, the PPI for December were also showing a little bit of an uptick, a little bit higher. So it did not surprise me that this came in higher, but this is, again, that we're also a couple months back on this now. I have a feeling that when you see the January numbers, you're going to see a slight you're going to see that come down a little bit, not dramatically, but you'll probably see it come back down to 2.9, maybe even 2.8, would be my guess there on this. So again, I think it's just a case of these data was a little behind, and we're still seeing numbers from back in December, which, almost 2 months on here. Again, that didn't really bother me that much. And I think you saw from the market reaction today, it wasn't that big of a deal. Now with the GDP, what happened here with the GDP? Well, the GDP missed because of the government shutdown in the fourth quarter last year. The question was, as it says here in this article, that basically, I believe in the article here, it says that, GDP was off. They took 1% off of GDP for the shutdown, but then President Trump said that it was 2% that was attributed to the shutdown. So is it 1%? Is it 2%? I'm not totally sure. Again, we could probably debate that as to what the degree of the severity for what caused here. But here's what's not arguable. There's no doubt that this number missed because of the government shutdown. The government shutdown, turned what should have been a very nice GDP report into a not so good number. So there's no doubt about that. So I would expect this GDP number to hopefully bounce back in the first quarter this year. But again, we are dealing with a little bit of yet another government shutdown right now. Not as bad as what we saw in the fourth quarter last year, but still going to cause some, level of disruption here in, over the next few weeks and next month. So, but let's see what this says for us. So gross domestic product rose at an annualized rate of just 1.4%, according to the Commerce Department, well below the Dow Jones estimate for a 2.5% gain. The department estimated that the government shutdown, which ran through the first half of the quarter, probably took about 1 percentage point off economic growth. At the same time, inflation held firm in December, according to a gauge most closely watched by Fed officials that increased 3% from a year ago. So, again, gross domestic product rose at an annualized rate of just 1.4%, according to the Commerce Department, well below the estimate of 2.5% gain. Consumer spending increased at a slower pace for the period, while government spending tumbled sharply in a quarter marked by the record length shutdown. The department estimated that the shutdown subtracted about 1 percentage point from growth, though it added that the exact impacts cannot be quantified. And this is what I meant by, okay, they're going to argue back and forth. I'm trying to think, do they quote Trump here as basically saying that, so basically, just before the data release, President Donald Trump warned that the GDP number would be soft, blaming it on the government shutdown that ended in November. The Democrat shutdown cost the USA at least 2 points in GDP. That's why they are doing it in mini form. Again, no shutdowns, Trump said in a Truth Social post. And then he went after Powell for interest rates after that. But it also says here, the federal government shutdown clearly sent the economy careening off its strong growth path in the fourth quarter, which is one-off. That won't be repeated in early 2026, said Chris Rupke, chief economist at Forward Bonds. So again, I agree with Chris's assessment here. Again, I think this is a one-off. I think the government shutdown was a one-off that really hurt this. I would be of the opinion that the government shutdown probably did take probably closer to 2 points off of this. Just looking at this number, because we probably should have had 3%. I mean, I know at one point the Atlanta Fed GDP now, their estimate was like 5.4% GDP growth in the fourth quarter, and the Dow Jones was estimating 2.5% gain. Probably thinking, will probably come in somewhere in the middle, maybe 3.5% or whatever. So if you take 2 points off of that, you end up with 1.4%. So again, I think that this probably should have come in around 3.5%, but came in about 1.4% because, like I said, the 2 points got taken off for the government shutdown. So, and then we get the PCE. So the core personal consumption expenditures price index, which excludes food and energy, rose 3% in December, up 0.2 percentage points from November, according to a separate release. That matched the consensus forecast, but kept the pivotal inflation measure well above the Fed's 2% target. On a headline basis, the PCE index accelerated 2.9%, or 0.1 percentage points higher than expected. Both indices rose 0.4% for the month, compared with the respective forecast for 0.3%. On a monthly basis, goods prices climbed 0.4%, while services increased 0.3%, indicating that the price pressures remained relatively broad-based rather than concentrated in any single category. Fed policymakers have been watching that balance closely to see whether inflation is being spurred by temporary tariff-related pressures that would hit goods, or more fundamental demand-driven factors that would show up in services. So again, and we're going to talk about the Fed minutes in just a few minutes. We'll get into I got a couple articles here around the minutes for the last Fed meeting in January came out this week, and had some very interesting things. The Fed very divided over whether they should, basically reduce rates. Some want to increase rates. Some want to reduce rates. Some want to just hold things steady and hold things pat for right now. So like I said, but we'll get into that discussion in just a minute. So, not a great day. Certainly, obviously, the tariff news was bad. Fourth quarter GDP number was not good, and then obviously the inflation number here, or the PCE index for December, not coming in so it was like a triple whammy today. Not great. But I look at this as more of this is a cloud. This is a cloudy sky. This is not a massive rainstorm. This is not like a hurricane coming, blowing through, or a tornado. That's not what we have here. I do believe that next month, when we get the January numbers for the PCE, I think, like I said, I think they will look better. I think you will get a PCE that comes down, like I said, probably 2.9, 2.8%, something like that. I would not be surprised if you get a slightly better core number there. I think the GDP numbers, were greatly affected by the government shutdown. So I think the GDP numbers will bounce back. And I don't think the tariffs are going anywhere. I think that Trump is basically going to regroup from this. They're going to target some of the other laws and things that are already out there, and they're going to go right back at people. I think for all those, again, cheering this, that think like, oh, this is great, we'll all get all our money back, everything will go back to the way it was. No, you're not getting your money back. It's not going to go back to the way it was, and deal with it. It's just you're just going to get, you're just going to. And here's the other thing. Maybe you get your money back, and maybe you don't. And what I mean by that is that, so maybe the government comes out and says, I'll tell you what, we're going to give you that money back. So say a country's owed, so say they said earlier that a country could be on the hook for 170, or the U.S. could be on the hook for 175 billion, right? Okay. Say a country's owed $5 billion of that money, right? So they could sit there and say, I tell you what, we're going to give you the $5 billion back, but we're going to hit you with this new tariff. It's going to be higher, and you're now going to give us back $7 billion. Okay, so did you really get that money back? I mean, they might hand the $5 billion back, and then they got to hand $7 billion right back to us. So did you really get the money back? No, it was basically a waste. So you did get the money back, but then you had to pay more to come back in. So again, I think that is probably more likely for how this thing is going to end up working at the end of the day. So, but again, but still, even with all that said, yeah, not a great day. But surprisingly, if we go back, I just want to go back here to show everybody something here. Yeah, the market was up 230 points today. Dow Jones was up 230 points. The S&P was up 47. The Nasdaq was up 203. So despite kind of all this craziness, the markets were up today. So the markets did not get overly concerned with the GDP and inflation numbers. I think they probably looked at it the way that I did. And as far as the tariff stuff, like they looked at the tariff stuff as like they took that as like a big win. Oh, this is great for these countries. For everybody else, they get to get away with paying up on all these tariffs. I don't view it like that. I view it as a really bad thing, but the market viewed it as a good thing. So okay. So like I said, I just want to show that to everybody. I mean, again, you might have gotten the impression that with all that bad news today, the market was probably down 1,000 points, and it wasn't. It was not at all. So, oh no. And then, yeah, we kind of already covered this. So Fed's favorite inflation gauge showed consumer prices remained elevated in December. We kind of went over that. So, okay, let's look at this. So U.S. factory output jumps. Core capital goods orders signal solid business investment. So stronger manufacturing production and rising equipment orders point to a tentative rebound in U.S. industrial activity. So again, this is the good stuff right here. This is the tariff policies in play right here. And a lot of, you had a lot of pieces in the Wall Street Journal over the last month or so, basically saying, oh, the manufacturing activity is down and this hasn't worked and this and everything. This was never going to this plan is a multi-year plan. It's a 4-year plan. It's actually probably more like an 8 or 12-year plan. And I think to fully realize it, to fully see it through all the way to the end, you would probably have to get another Republican president in there for 8 more years past Trump, and they would have to carry on Trump's policies. I think that is the reality of this whole plan. And and again, because it was going to take 3 to 4 years for all of this to really start to kick in, to really see all the fruits of this. Remember, what did Trump do last year? He lined up like $6 trillion of money being invested into the U.S. in new manufacturing plants, new this, new that. And a couple of examples that I just saw here in my neck of the woods in Pennsylvania just this last week. Eli Lilly committed they're building a $3.5 billion plant. Was it Johnson & Johnson? I think it was J&J. I think it was Johnson & Johnson. Basically, they're building a $1 billion, 1.2 billion plant, not far from me here, from where I live. So again, you are beginning to see this activity. It is coming, but again, it takes a while for this stuff to kick in. But I think you're just starting to see it now. I basically said that I thought that by the end of this year, by the end of 26, beginning of 2027 was when you were really going to start to see this really kick in and really begin to work. So, but let's look at this for just a second. So, U.S. industrial production rose in January by the most in nearly a year, and orders for key business equipment increased more than expected in December of 2025, pointing to firm capital spending and signs of a pickup in domestic manufacturing. Industrial production increased by 0.7% in January after rising by 0.2% in December, according to the Federal Reserve's G17 report released on February 18th. This is a significant improvement compared with the lackluster performance over the past 6 months, which included numbers as low as a 0.4% contraction in industrial production in October. Manufacturing output, which accounts for roughly 3/4 of total production, advanced 0.6%, the largest gain since February of 25. Gains were widespread across industry groups, suggesting a broad-based lift in production. Durable manufacturing output surged by 0.8%, including gains in nearly all industries, such as motor vehicles and parts, which rose for the first time in 5 months. After the AI boom sustained the business spending category, of gross domestic product in the first 3 quarters of the year. Firms outside of the tech space began to re-engage late last year, setting the stage for a noticeable pickup in investment outlays in 26, said Stephen Stanley, chief U.S. economist at Santander U.S. Capital Markets. This has been and continues to be my main justification for expecting an above consensus economic performance in 2026. Factory output jump aligns with recent survey-based reports from the Institute of Supply Management and S&P Global, which show January production at U.S. factories growing at its fastest pace since mid-2022, following months of mixed readings marked by weak growth or bouts of contraction. All major market groups had output gains in January. Consumer goods production was up 0.7%. Business equipment rose by 0.9%. Capacity utilization for total industry rose 76.2% in January, up from 75.7% in December, although still below its long-run average. So, again, this is really great stuff. But this is just, you're just scratching the surface here. This is just scratching the surface. Nothing crazy happening here yet. So, all right, let's see here. All right, I want to get into the private credit stuff, but I'm going to hold this for a few minutes. I want to get into, because I want to shift gears here for a minute. I want to get into our economic indicators. This is the point in the program where I like to shift gears. I like to talk about the economic indicators coming up this week. I like to talk about the episodes that I put out for the channel this week. And I like to give everybody some banking news. So let me tell you what, let me just get a sip here before we get into the economic indicators here. My shameless Diet Coke plug here. So, although I'm not getting any money from Coke, I wish I was. No, you know what I really wish? I wish I had that red button that Trump has on his desk. He hits the red button and they did bring him the Diet Coke. I love that. I as a Diet Coke addict myself, I need a red button to hit. Bring me my Diet Coke. Anyway, sorry, I was mindless ranting on a Friday night here. All right, so what are our economic indicators coming out this week? So on Monday, February 23rd, we have factory orders for December of 25. On Tuesday, February 24th, we get the ADP Employment Change Weekly. We get the CB Consumer Confidence. We get the Atlanta Fed GDP Now for the first quarter. The 2-year Treasury Note Auction. On Wednesday, February 25th, we get the 5-year Treasury Note Auction. On Thursday, February 26th, we get initial jobless claims, continuing jobless claims, goods trade balance, the 7-year Treasury Note Auction. On Friday, 27th, we get the PPI, the Chicago PMI, the construction spending, the Atlanta Fed GDP Now, and the U.S. Baker Hughes total rig count. So a lot of good economic indicators coming out this week, a little slower than some of the stuff that we've seen over the last few weeks, but still good stuff, no doubt. So, okay. I don't want to spend an exorbitant amount of time on these couple items, but I do want to show them to everybody. So, the FDIC, I just wanted to show this to everybody because this is going to play in to our conversation on private credit. So, excuse me. So private credit, one of the biggest customers basically in the private credit market is lending to non-depository institutions, so NDFIs. So this paper, basically the FDIC came out with this paper this week that I thought was really interesting, and I'm going to be doing an episode probably this week I want to go over this whole report and really delve into this, but I just wanted to give everybody the highlights here for a minute. So FDIC, so loans to non-depository institutions increase. So bank lending to non-depository financial institutions has been the fastest growing loan segment since the global financial crisis, according to the FDIC. So from 2010 to 2024, outstanding balances of bank loans to NDFIs reported quarterly on call reports rose at a compound annual rate of 21.9%, almost 3 times as high as the next fastest growing segment. More than half of bank lending to NDFIs is to credit intermediaries, and about a quarter is to private equity funds. That's how private equity gets involved in this. The NDFI share of the financial sector has not grown since 2000, but the composition of NDFI assets has shifted. Bank lending to NDFIs has lower delinquency rates than similar loans to businesses not secured by real estate. Maybe. Maybe we'll see there in a second. We'll see there, yeah, later. We're going to take a look at what's going on in some of the private credit market. But again, this ties in. Again, I always have to put this shameless plug in here. The Lords of Easy Money. If you have, hang on, right here. Sorry, right here. Right here. I'll zoom out of this for a second. Right here, The Lords of Easy Money by Christopher Leonard. If you have not read this book, you need to read this book. This is because this, if you understand this, you'll understand why this has happened. You'll understand what this growth. Notice they said, when did this really start? In 2010. Well, what happened in 2010? Oh, that's right. That's when the Fed decided to do their ZIRP policy, zero interest rate policy, hold rates at zero for the next 10 years, and quantitative easing, massive quantitative easing. That's what opened the door for the banks and all of this lending to NDFIs. And then the COVID pandemic basically turbocharged it. But if you understand, and again, go watch my Lords of Easy Money series. Go watch. So the main star of the book, if you will, is Dr. Thomas Honig, who is one of the dissenting voters at the Federal Reserve back in 2010, because he saw all this. Thomas Honig saw all this coming. If you go to my Lords of Easy Money series, you can watch the interview that I did with Dr. Thomas Honig. Okay, that's the last episode of the Lords of Easy Money is my interview with Dr. Thomas Honig. You could go and watch the interview. We talk about some of this stuff in that interview. But again, he saw all this coming. He saw how that this was all going to play out. A lot of people called him nuts. A lot of people said, oh, the guy, he's lost it. He doesn't know what he's talking about now. He got lambasted by people. And the problem is that a lot of times in economics and in finance and in the economic world, the business world, things don't happen overnight. Sometimes they don't happen in a year or two. Sometimes it literally takes 5 years, 10 years for a lot of this stuff to play out. It just does. And again, I think, Thomas Honig, he understood the long game. He understood that 15 years down the road, this is where we were going to be. And voila, here's where we're at. So, all right. So I wanted to point that out. The other thing I wanted to show everybody was this. So I had talked about the fraud in Minnesota. And one of the things that FinCEN, so the Financial Crimes Enforcement Network, FinCEN, which is part of, I believe FinCEN is part of the United States Treasury. So FinCEN put this out. This came out on January 13th, but they put out a geographic targeting order involving money transmitters and banks in the counties of Hennepin and Ramsey in Minnesota. Now, on January 8th, 2026, FinCEN issued a geographic targeting order, also known as a GTO, requiring all banks and money transmitters located in Hennepin County and Ramsey County, Minnesota, to file reports with FinCEN of certain international fund transfers of $3,000 or more. The terms of the GTO are effective beginning February 12th, 2026, and ending August 10th, 2026. So to assist covered businesses in complying with the GTO, FinCEN has developed this list of frequently asked questions. These frequently asked questions are applicable only to this GTO and do not apply or alter any obligation arising under any other FinCEN regulation or order, including other GTOs. So, and again, it goes into one, like, what is a geographic target? It explains what is a GTO. Well, a GTO is an order issued by FinCEN under the Bank Secrecy Act, BSA, that imposes additional record keeping or reporting requirements on domestic financial institutions or non-financial trades or businesses in a specific geographic area. Then it goes into, why did FinCEN issue the GTO? Well, government benefits fraud is a widespread issue in Minnesota. Extensive schemes have fraudulently diverted state and federal dollars meant for people who lack housing, are food insecure, have disabilities, or are otherwise eligible to receive government benefits, costing the state of Minnesota hundreds of millions, if not over $1 billion. And it says a portion of which was laundered overseas. Number 3, what does the GTO require covered businesses to do? Well, and this basically just goes into tracking, just, hey, give us a certain amount of information. Number 4, how do I know if my business is a covered business? What geographic areas are covered by the GTO? What information must be reported under the GTO? And then, how should the covered business collect the information reported under the GTO? Does the GTO apply to covered businesses that use the ledger entries? Does the GTO apply to covered businesses involved in convertible virtual currency? How do covered businesses report under the GTO? So it gives you all that specific information in here. And I would tell people, if you need to find this for some reason, like if you're a banker out there listening to this, you want to look it up, you could do a simple Google search. You could just put in FinCEN GTO for Minnesota, and I'm sure it will pop right up. This is a 7-page PDF, basically, that I was again able to get. But I just wanted to show this now. Again, to my point that I had made a couple weeks ago when I first started talking about this, and I came to this from a banking perspective, not a political perspective, not political, but a banking perspective. And I basically said that I looked at the fraud that occurred in Minnesota, and I just said, you know what? There is a very real chance that same fraud is being perpetrated in a number of other states, if not most of the other states around the U.S. And I just had a gut feeling that I was like, this looks like something that could metastasize. And banks are going to get pulled into this in some way, shape, or form. And sure enough, what happened? You had FinCEN come out and said, hey, we're issuing this GTO. And wait for it, we requiring all banks in that area to basically help with money transmitting and basically file reports with FinCEN of uncertain international funds transfers of $3,000 or more. So this is a perfect example of what I was talking about from a bank perspective. You're going to get pulled into this at some point. So what I had said was basically like, hey, just be prepared, be ready. Look at, do a check, look at your customers, look at your depositors, maybe look at some of the CTRs and the BSAs that have been filed over the last, year or two. Maybe go back and look at some of that stuff and basically say, hey, do we have anything that could be questionable? So that when FinCEN and maybe even the IRS come knocking on your door, you're ready to go. If you've got a couple problems, you can bring that out right up front and say, hey, we do have a couple potential issues here. Here's some customers that we're keeping an eye on. They've been transferring money overseas. They've been doing this. They've been doing that. Maybe they already filed some SARs on them. Who knows? But like I said, I think the more you prepared that a bank can be for this, the better off you're going to be. So that's my warning, my soapbox there on that. So those were the two things I just wanted to show everybody real quick. And now we can I'll flip back to the economic indicators here for a minute. So now let me just run through the episodes that I had come out this week. So I had 6 episodes come out this week. The first thing I put out was I put out a bonus episode last weekend on Sunday, which was just a clip from last week's live stream. And that was just basically covering the Epstein fallout. The Epstein list fallout ripples across Wall Street and finance. So basically, what did I say there? So the disclosure of the Jeffrey Epstein documents has sent shockwaves across Wall Street and the financial world. A judge ruled that a lawsuit against Bank of America from an Epstein victim can proceed. Goldman Sachs main attorney Catherine Rumler resigned. Brad Karp, the chairman of law firm Paul Weiss, he resigned over the Epstein files. Casey Wasserman is selling his talent agency, Wasserman, after intense backlash over his relationship with Epstein. DP World CEO resigns over Epstein allegations. Howard Lutnick was caught lying about his relationship with Epstein. And then Epstein's ties with Silicon Valley go far deeper than what was originally thought. And this week, I have a couple articles here that we're going to go over in a minute. We have even more fallout from the Epstein, just scandal, if you will. I mean, it's just wild. And I said last week, I said, this was probably just the tip of the iceberg. We probably have a lot more that's going to come out here, and I do believe that. Then on Monday, I basically did episode 36, or the 36th installment of the crypto series. And this was titled Crypto Bonds, Bitcoin Miners, Botched Prizes, and Fourth Quarter Losses. So in this episode, we checked in on the continuing volatility of Bitcoin. We did an update on Coinbase as they suffered a fourth quarter loss to end 2025. Strategy, Michael Saylor's company, is still holding strong, literally holding strong. What a potential winter in stablecoins could mean for the crypto world's broader ambitions. Bitcoin miners are converting facilities into AI data centers. A Bitcoin-backed bond sale by Jefferies went sideways. Why crypto is perfect for tracking down criminals. And then finally, a $40 billion blunder as South Korean cryptocurrency exchange makes a massive mistake in a prize giveaway. So a lot of information covered there in the episode 36 of the crypto series. Then on Tuesday, I did what I thought was a very important episode. And, and that is, this was called Are Prediction Markets Trading or Gambling? And this kind of came hot on an episode I did 2 weeks ago, where I talked about the rise of prediction markets. And then I did this follow-up which is, are prediction markets trading or are they gambling? Are the people that use prediction markets traders or gamblers? In this episode, we look at how one trader lost $100,000 on the Super Bowl, how Robinhood is cashing in on the action, and why Robinhood's CEO sees prediction markets entering a super cycle. There should be a lot of concern around the growth of online gambling. There should be a lot of concern about how all the major sports leagues are cashing in on the action. There should be a lot of concern around how prediction markets are skirting the law to offer trading options. There should be even more concern about how apps like Coinbase and Robinhood and Wall Street firms want to further juice the trading. So again, I think that this will prove to be a very important episode that I've done, over time. And like I said, I have a few more articles here tonight to talk about some of the updates with prediction markets with the CFTC. So we'll talk about that in just a little while. But again, I'm like I said, I'm highly, highly concerned about the rise in the prediction markets, because this, to me, it's not trading, it's gambling. It's just straight gambling. It's all straight gambling. And I find it highly disturbing, because they're like the kid that I highlighted in this last episode, where he's like, oh yeah, he's become a professional prediction markets trader. I would say, no, you've become a professional gambler. I wouldn't call it as not trading, as it is gambling. And so I think it's important to make that distinction. And again, for everyone who might be a winner, you're going to see, massive losers. Like, again, this kid, he lost. What was so disturbing about this was he lost $100,000, and his comment to that was like, well, you just kind of get numb to these numbers after a while. You get numb to these numbers. If that is not somebody with a gambling addiction, I don't know what it. I've had friends who were serious gambling addicts. And guys who literally gambled lost their cars. Like, I would just crazy stuff, because they literally could not stop gambling. And it's a horrible, horrible vice. And I hate to see so many young people potentially getting exploited because of this right now. And like I said, they're all cashing in. Everybody's cashing in on it. All right. So anyway, I digress. So on Wednesday, I did an SBA update. This episode was titled SBA Update, Citizenship Requirements, California Fraud, and EIDL Collections. So the SBA recently updated its SOP, which is that's its standard operating procedure, to reflect changes to citizenship status. The requirement states that 100% of all direct and or indirect owners of small business applicant must be a U.S. citizen or a U.S. national who have their principal residence in the United States. Additionally, The SBA is going after fraud in California, specifically around PPP and EIDL loans made during COVID. The SBA is also ratcheting up debt collection of EIDL loans that are in default. And then finally, I gave a shout out to a guy who I've known for a long time, Rocco Perrate, who is leaving a local bank here in PA called Meridian Bank to start a new SBA lending firm called Lafayette Square SBLC. So that was the SBA update there. Then I covered Thursday and Friday. I covered what I thought were just interesting stories. So on Thursday, I did retail e-commerce ventures founder Tay Lopez accused of running a Ponzi scheme. So Tay Lopez, the founder of Retail E-commerce Ventures, also known as REV, has been accused by the SEC of running a Ponzi scheme. He is currently being investigated by the FBI, but as of yet, no charges have been filed. Ty and his partner, Alex Muir, set up Rev to use as an investment vehicle. They started buying defunct retail brands such as Radio Shack, Pier 1 Imports, Dress Barn, Models, Sporting Goods, and linen and things. The idea was that the retail brands could be purchased at very cheap price points and would be revived using an online e-commerce strategy. In other words, strictly online sales. This turned out to be a bad idea as these brands were defunct and could not be resuscitated even in an online form. So Tay and Alex raised $230 million from 660 investors. Now those investors are out a lot of money and everyone is left with a lot of questions. So now again, Mr. Lopez is basically just claiming that, hey, sorry, it was just basically a bad business investment. What can you do? It just is what it is, and it goes on. But I think a lot of people are saying, well, wait a minute, hang on. It looks like potentially a lot of the funds here could have been misappropriated, that the money wasn't used in the right way. That basically the initial investors, like, why does the SEC and FBI think he's running a Ponzi scheme? Well, because the original investors were getting paid out with return. First of all, they were promised ridiculous, unrealistic returns. That was number one. And then the original investors were getting paid out with all the investment that was coming in from the new investors. And that's a classic Ponzi scheme. And then basically once the money stopped flowing in, then the original investors, basically it just goes like dominoes. The money stops flowing in, the original investors stop being paid, and then pretty soon everybody else stops being paid, and then the whole thing blows up and gets exposed. And so so everything follows with kind of the classic format or the classic play out of your typical Ponzi scheme. So like I said, but we don't know that. We don't know that for a fact. Like I said, it's alleged. He's just been accused. He hasn't been charged with anything yet. So we got to wait to see like what happens there. But again, I thought it just, but again, I also thought that story was a great example of if something is too good to be true, it probably is. And it almost all the time, it most assuredly is. And, you have to be very careful about the type of investments that you get into. I mean, and what is really sad and heartbreaking is that you see the investors who are like, oh yeah, I had 250,000 saved up and I was going to use that to put my kids through college. And I decided to throw it in this fund because I thought, based on what they were promising, I thought, oh yeah, I'll double my money and then I'll be able to retire early. And instead of retiring early, now all that money that he had worked so hard for and saved up for his kids to go to college, it's all gone. It's all gone. And so, sometimes you can't let greed get the best of you. You have to remain focused, and when necessary, you have to seek out professional advice. You have to seek out other people's opinion on these kind of things, especially as you get into a world where you're basically talking about alternative assets. You're getting into a world of private placement memorandums and initial public offerings and private stock sales and things like that. You start getting into that world. You need to know some people. You need to know some financial advisors, maybe some lawyers, some private equity guys, maybe an investment banker that knows that world and deals with those kind of investments all the time. You get the prospectus. And because again, if there's no prospectus, then you know it's a sham from the start, because securities law requires there to be a prospectus. Securities law requires that basically the person who is pushing that investment, they have to vet you. They have to determine that you're an accredited investor, that you have the money. They have to present you with a prospectus. There's all these rules out there that are in Reg D of the securities law. And you could do a simple Google search. You could do Ask Grok, ask Chat GPT, say, hey, talk to me a little bit about securities D or Regulation D, securities law. And it'll put it all out there. It'll tell you like these are all the things that a prospective investor has to do. And like I said, so if you do get a prospectus, take it to somebody that knows what they're looking at and say, hey, can you just take a quick glance at this and let me know? Do you think this sounds legit, or does this sound like nonsense? But unfortunately, too many people don't do that. But again, that's my advice for the night, my 2 cents for the night. Always get a second opinion on this stuff. So, all right. And then finally, earlier today, I put out an episode which I thought was really interesting. Florida's condo market sees big changes with new laws. So after a condo building collapsed in South Florida a few years ago, new legislation has been put in place around disclosures condo associations have to provide to potential buyers. The new law requires condominium associations with 25 units or more to provide a secure portal where buyers can view documents that include bank statements, reserve details, and structural reports. Furthermore, the recent Biscayne 21 court ruling granted minority holdouts, which can be as few as 5 to 10% of owners, the ability to block a sale or any proposed major redevelopment. These changes to the condo market in South Florida will have repercussions for years to come. So again, I just thought that this was really interesting. A really interesting development in Florida's condo market, because obviously that's a hugely popular market. A lot of buildings after you had that condo collapse there in South Florida, that kind of sent shockwaves through the market, because you had a lot of condo associations that were underfunded, had a lot of maintenance that just had been put off, hadn't been dealt with for perhaps decades. So very, very interesting there. Indeed, just taking a look at that. So thought that was an interesting story. Anybody out there who maybe owns a condo in Florida or is maybe thinking about purchasing a condo in Florida, good to take a look at this. Good to understand what's going on there. Maybe banks, if you're a banker out there, if you're financing that real estate in Florida, good to know this stuff, right? So, all right. But that was the 6 episodes that I put out this week. Like I said, most normally we have new episodes Monday through Friday, usually premiere every day at noon. Most of the episodes are generally 10 to 20 minutes in length. And that's generally the format of what I put out during the week. So, all right, let's get to some banking news real quick here, shall we? So, okay. Housing starts and building permits were up in December. Durable goods orders were down in December. Industrial production capacity utilization increased in January. Pending home sales dropped in January. Wholesale inventories increased in December. And let's see here. New York Fed survey, business activity increases in February. So business activity increased modestly in New York State in February, according to the Federal Reserve Bank of New York's Empire State Manufacturing Survey. Business confidence dips in February. USDA announces specialty crop assistance. So the Agricultural Department announced $1 billion in assistance for specialty crops and sugar not covered through the previously announced Farmer Bridge Assistance Program. The USDA said the one-time bridge payments will help address market disruptions, elevated input costs, persistent inflation, and market losses from foreign competitors engaging in unfair trade practices that impede exports. Specialty crop producers have until March 13th to report 2025 acres to the Farm Services Agency. Consumer prices were up a little bit in January. Fed officials unsure how fast inflation will fall in the minutes. We'll get back to that. We'll talk about that here in a couple minutes. The ICBA participated in a third White House meeting on digital asset market structure priorities. So ICBA attended a third White House meeting focused on the debate over pending digital assets market structure legislation. At the meeting of administration officials and digital assets industry representatives, ICBA and other banking groups continued to reiterate the importance of explicating, bearing crypto exchanges, barring crypto exchanges, affiliates, and other intermediaries from paying interest, yield, or rewards on payment stablecoins. So again, crypto legislation still stuck on kind of this impasse. Michelle Mickey Bowman says the Fed continues to work to improve community bank capital standards. Yeah, we'll talk about that one too in a few minutes. G20 meeting to cover digital assets, cross-border payments, and fraud/scams. So the Treasury Department announced the G20 finance track meetings for 2026, which include an emphasis on digital assets, cross-border payments, and fraud. So we'll keep an eye on that one. The Fed hosted the EGR-PRA outreach meeting next month. So the Federal Reserve announced it will hold a public outreach meeting next month as part of its review of regulations under the Economic Growth and Regulatory Paperwork Reduction Act. ICBA had an op-ed. Durbin Marshall credit card restrictions would harm consumers. So a new op-ed from ICBA community banker Sarah Getzlaff says community bank credit card programs can provide local customer service, rewards programs, and fair terms are under threat from legislation designed to benefit big box retailers. So a little background here. So the ICBA opposed Credit Card Competition Act would require certain financial institutions to offer merchants at least two networks to process credit cards, at least one of which cannot be owned by Visa or MasterCard, allowing merchants to process credit card transactions based solely on which network offers them the lowest cost. So here's kind of the good and bad on that for just a second. So I like this, but the problem is the second rail doesn't exist. Like you got Visa and MasterCard. I like the fact that you're trying to create an alternative to kind of, not quite break Visa and MasterCard's monopoly, but maybe reduce their stranglehold a little bit. Because obviously the second rail thing's not going to just take off overnight. But obviously Visa and MasterCard hate this. They're doing everything they can to fight this. But the reality is that second rail just doesn't exist at the moment. I mean, there could be a couple potential things that could happen with that, but it just doesn't exist. So even if the Credit Card Competition Act got approved and got put through, it would be basically at the moment as it stands, it'd be kind of a hot mess. So, or at least it wouldn't really work as intended. So like I said, we'll have to. So again, I think there's some good and there's some bad there, but I think there have to be a few more developments in order for that thing for the Credit Card Competition Act to really act. But I think there are some concerns that this would really just benefit the big box retailers, and I think those concerns really need to be addressed. So anyway, okay. Treasury initiative to promote AI cybersecurity and risk management. So the Treasury Department announced a public-private initiative to strengthen cybersecurity and risk management for artificial intelligence in the financial services sector. Labor Department releases AI literacy framework. So the Labor Department published a framework to guide nationwide artificial intelligence efforts across workforce and education systems. The Labor Department said the framework outlines 5 foundational content areas and 7 delivery principles for AI literacy. It is intended to be a resource to guide program design and development of AI while allowing for flexibility and adaptation across industries. Michelle Mickey Bowman previews Fed proposal to support bank participation in mortgages. Yeah, we'll talk about that. OCC proposes changes to appeals process. So the OCC proposed establishing revised procedures and policies for appeals by OCC supervised entities of materially supervisory determinations. The OCC said the proposed changes are intended to enhance the independency and efficiency of the bank appeals function. The proposal includes adding an appeals board to hear bank appeals, enhancing the role of the ombudsman as a neutral liaison to help banks seek redress for grievances, establishing a de novo standard of review for appeals, and strengthening prohibitions against retaliation. Comments on the attached proposal are due 60 days after the date of publication in the Federal Register. FinCEN relaxes certain beneficial ownership requirements. So FinCEN announced it is relaxing parts of its 2016 rule that requires covered financial institutions to identify an entity's beneficial owners each time the entity opens an account. So in other words, what they're saying here is that they still want banks to cover the beneficial ownership requirements, but they just have to do it the first time. Basically, like they open an account for the first time, they get the information and they're good. And so if that entity or that individual or borrower wants to, get additional loans in the future or wants to open new accounts, whatever, like you don't have to go through you don't have to recreate the wheel, basically. You don't have to go through the whole thing again. So, and then finally, FinCEN launches whistleblower webpage. So the Financial Crimes Enforcement Network launched a webpage to confidentially accept whistleblower tips on fraud, money laundering, and sanctions violations. And then a new farm bill was introduced. So the House Agricultural Committee Chairman Glenn Thompson introduced a new farm bill and said the committee would hold a markup on it this month. So Thompson said the Farm, Food, and National Security Act of 2026 would provide certainty to farmers, ranchers, and rural communities, builds on the ag investments made last summer in H.R. 1, and is very similar to its namesake in 2024 with a few key updates. So again, going to keep an eye on that one, but that is the banking news I basically have for everyone here. And now we can get back to some of our stories here. So where were we at here? Let's see here. We did that. Okay, let's talk some private credit here for a few minutes, shall we? So Blue Owl really stepped in it this week. So Blue Owl curbs investor liquidity following asset sale. Shares slide almost 6%. So we're going to kind of follow this story here over the last couple of days. So we're starting basically 2 days ago. So Blue Owl Capital will tighten investor liquidity in its retail-focused Blue Owl Capital Corporation 2 fund after offloading $600 million of portfolio assets. The move comes as part of a larger $1.4 billion sale by the private asset manager of assets to a number of North American pension fund and insurance investor. The deal follows an unsuccessful merger of Blue Owl funds last November and highlights the liquidity and transparency issues in private markets. So I had talked about this last November and December. So Blue Owl basically had two funds. The two funds basically started to take on a lot of delinquency. They tried to merge these funds together, and the investors in those funds said, whoa, wait a minute, time out. Hold on here, something ain't right. If anybody's, you'd have to see the meme. But anyway, so basically the investors put the kibosh on it. And not only did they put the kibosh on it, they basically said, hey, by the way, we'd really like to get our money back. So they've had this withdrawal of funds here, and this has reignited some issues here, as we're going to see. So then we got to canary in the coal mine. So Blue Owl liquidity curves fuel fears about private credit bubble. So Blue Owl Capital permanently restricted withdrawals from one of its retail-focused debt funds. Market watchers warn Blue Owl's move could be the canary in the coal mine. Yes. So the private credit boom is facing a new test after Blue Owl Capital permanently restricted withdrawals from one of its retail-focused debt funds. Shares in Blue Owl Capital fell nearly 6% on Thursday after the private market and alternative asset manager sold $1.4 billion of loan assets held in 3 of its private debt funds. The biggest portion of the sale came from a semi-liquid private credit fund marked to U.S. retail investors called the Blue Owl Capital Corporation 2, which will stop offering quarterly redemption options to investors, reigniting debate over whether stress was beginning to resurface in one of Wall Street's fastest growing corners. This is a canary in the coal mine. Dan Rasmussen, founder and advisor at Verdad Capital, told CNBC the private markets bubble is finally starting to burst. The broader concern is that years of ultra low interest rates and thin yield spreads encourage lenders to make riskier moves, financing smaller, more leveraged companies at yields that appeared attractive compared with public markets, market watchers said. Years of ultra low rates and ultra low spreads have very few bankruptcies led investors to go further and further out the risk spectrum in credit, Rasmussen said. This is a classic case of fool's yield, a high yield that doesn't translate into high returns because the borrowers were too risky. Private credit, which was generally direct loans made by non-bank lenders to companies, have ballooned into roughly $3 trillion market globally. So yes, and this gets back to this report that I just showed you guys, bank lending to non-depository financial institutions. So again, this gets right back to all of that. But let's go back here for just a second. So now we get to today. So illiquid loans, investor demands. Blue Owl's software lending triggers another quake in private credit. So Blue Owl, a direct lender specializing loans to the software industry, said Wednesday it had sold 1.4 billion of its loans to industrial investors at 99.7% of par value. That means sophisticated players scrutinized the loans and the companies involved and felt comfortable paying nearly full price for the debt, a message that Blue Owl co-president Craig Packer sought to convey in interviews several times this week. But instead of calming markets, it sent shares of Blue Owl and other alternative asset managers diving on fears of what could follow. Most of the 200 plus companies Blue Owl lends to are in software. More than 70% of its loans are to that category, executives said Wednesdays in a fourth quarter earnings call. So Blue Owl has what we would classically call in the banking business a major concentration, meaning that you put a lot of eggs into one basket. So most of the 200 plus companies that Blue Owl lends to are in software, and more than 70% of its loans are in that category. So again, you have a major, major concentration there. And then we go in here, this is from the Wall Street Journal. So private credit warning signs flash after Blue Owl unloads 1.4 billion in assets. The sale raises fears that the industry's efforts to court individual investors will suffer. So yes, absolutely. So Wall Street has been eagerly selling private credit as a hot opportunity for individual investors. That sales pitch just got a lot tougher. And it says Blue Owl unloaded this. But instead, the firm hoped that the sale would shore up wobbling investor confidence. Instead, the opposite happened. Stocks across the private fund industry slid as the deal raised questions about how much fund managers can count on individuals to stay invested in hard-to-sell assets for the long term. Blue Owl stock dropped 10% at one point Thursday and closed down nearly 6%. Shares of other private credit titans also sank, with Apollo Management and Blackstone both falling about 5%. Right now, it's reducing confidence and reducing what anyone is willing to pay for these stocks or assets, said Evercore senior analyst Glenn Schorr. Private credit funds use client money to make loans, largely to junk-rated companies, earning hefty interest payments that are handed out to investors through dividends. Stocks of these fund managers soared in recent years, in part on optimism that they could raise trillions of dollars from individual investors. That is already happening through funds targeting wealthy investors, like the Blue Owl one that is under pressure. And the industry is taking steps to make private fund investments available through 401k savings plans. I've covered that in some recent episodes if you want to go check that out. But the Blue Owl sale adds to a growing body of evidence of a disconnect between fund managers and individual investors. In private credit, firms buy harder to sell assets for longer periods of time with the understanding their clients will be willing to stomach some turbulence in the middle. Retail investors, however, are accustomed to trading out of investments whenever they choose. There are other signs that individuals are souring, including a jump in redemption requests at the end of 2025. More worrying to stock analysts, the flow of net investments that were expected to fuel future earnings growth is also slowing. Inflows to semi-liquid business development companies, or BDCs, that Blue Owl and others have sold aggressively to wealthy individuals dropped an average 15% over the last 3 months, according to research by Finch Ratings. Monthly inflows to the largest such fund, which is managed by Blackstone, dropped to 600 million in January from 1.1 billion in November. Fund managers say inflows still far outweigh redemption requests, reflecting pent-up demand from wealthy individuals, most of whom still don't own much private credit. If headlines stay bad and retail keeps reading them, we can expect more headwinds on flow into these funds, said Ben Bundish, a stock analyst at Barclays covering fund managers. Blue Owl's predicament began last year, and this is just a chart of monthly flows. And then let's go over and then let's look at this. So the Ivies are having second thoughts about investing in private equity. Interesting. So a crowded field and subpar returns have frustrated America's wealthiest universities, some of private capital firms' most loyal clients. So now here's where we get into the private equity piece of this. So private equity is on academic probation. Princeton University is lowering expectations for its endowment's returns because its private capital investments have disappointed. Yale trimmed its portfolio of leveraged buyouts for the first time in a decade. Harvard says cashing out of some private market investments early is now part of a long-term strategy. Private equity has counted America's wealthiest universities among its largest and most loyal clients since the industry's formative years, but the market for private company investments has turned more crowded, and returns now struggle to match broader stock market benchmarks such as the S&P 500. University endowments grew to lean on the once juicy returns of private equity to cover a larger slice of their overall budget. That strategy faltered when the long lockup investments returned an annualized 7.4% in the 3 years ended June 30th, according to Cambria Associates, much of it paper gains. Over that same period, the S&P 500 rose 19.7%. So again, yeah, a lot of, I wouldn't say that I do believe that there is a bubble in the private credit market. I firmly believe that. I've been saying that since last year. Is that bubble ready to burst? I don't know yet. I don't know. I'm not quite ready to say that. I think I would need to see some more blow-ups before I'd be ready to make that determination. I thought it was ready to blow last year when, you got the failures of First Brands and Tricolor Holdings, and there's about 10 or 12 other much smaller companies that went at that time as well. So I really thought, going back to October of last year, I really thought that you were going to start to see a blow up, because then you saw like Jefferies having problems. And then, JP Morgan, Barclays, I think some other banks basically had to have write-offs on these losses to Tricolor Holdings and to First Brands. First Brands CEO and his brother, who is, I think, involved in the company, they both been arrested and charged with fraud. And so you've had a lot of updates. You've had Blue Owl, having their problems in their private credit funds and all that. So again, we're seeing the cracks, though. The cracks are there. The cracks are starting to form. But again, like with any bubble, you need a catalyst. There has to be some big company blow up, which basically bursts the bubble and sends those ripples through the market, if you were. So that, I think, is the private credit thing. So now let's look at this for just a second. So lenders to commercial real estate owners, pay up now. So the delinquency rate for office building owners jumped to a record high last month. So let's see here. So lenders to commercial real estate owners are reaching the breaking point, calling in tens of billions of dollars of troubled loans. Refinancing property debt has become difficult since interest rates started to soar in 2022. Many lenders initially extended maturity loans they made when the borrower's costs were far lower, hoping that either interest rates would fall or that cash flows would grow. It is a strategy known as extend and pretend. And this gets into the whole maturity wall. I've done a couple of episodes on the maturity wall. I just did an update to that probably about a month ago. So if you want to go get the whole story on that, go check out those episodes. Now, many lenders have stopped pretending, and the default rate is surging. The delinquency rate for office loans and commercial mortgage-backed securities climbed to a record 12.34% in January, the highest level since TREP began tracking in 2000. The end of this forbearance reflects how lenders have made two determinations. For one, they are betting that mortgage rates aren't going back to historic low levels seen during the pandemic. Yes, absolutely. So here you can see CMBS office delinquency rate has spiked up to 12.34%. So pretty crazy there. Lenders to office owners in particular are also concluding that the decline in property values and cash flow aren't simply a response to the economic cycle. Rather, creditors increasingly believe that structural changes around the workplace and hybrid work have permanently reduced demand for most office space. The shift comes as the volume of distressed commercial real estate debt has climbed to levels not seen since the aftermath of the 08-09 financial crisis. More than half of the roughly $100 billion of commercial real estate loans packaged into securities and coming due this year are unlikely to repay at maturity, according to a January report by Morningstar DBRS. That compares with a maturity payoff rate of about 75% in 24 and 25, and more than 80% in 23, the firm said. Some of these loans ultimately will be modified and repaid, but a growing number are headed toward foreclosure or liquidation. One such case of a problem loan is a $515 million mortgage on the upper portion of the former New York Times headquarters building in Midtown Manhattan. The owner, Brookfield Asset Management, has extended the loan 5 times since 2020. So you can see here MBS maturity drag quarterly. So loans past the maturity date has declined, but you still got 2.65 billion, and then loans extended 1.38 billion. So still not great. So the debt was transferred to a special servicer late last year after passing its maturity date without repayment, and the property prepares to lose one of its largest tenants. We are taking the first step in opening a structured good faith dialogue with our lenders, the Brookfield spokesman said. The effects of these stalled loans extend beyond lenders and owners. Properties caught in limbo often go without the capital needed for maintenance, upgrades, and leasing, weighing on tenants and surrounding neighborhoods. So, in other words, once it's like a downward spiral. Once it starts to spiral, it will keep on going. So, many downtowns, including those of St. Louis, Portland, San Diego, and Dallas, are also struggling as so-called zombie office buildings drag on surrounding areas. I don't think we're through it at all, said Alex Killick, a senior managing director at CB Asset Management, a firm that works with troubled property debt. There is plenty more to come. Yes, I believe this is true. St. Louis, for example, they literally have, I think, something crazy. They have like a 15-block radius right smack in the middle of the city, which is just like a mess. I mean, you got like the buildings are all defunct. A lot of them are basically completely vacant. It's pretty bad. It's pretty bad. The Wall Street Journal even did an expose on that. I think it was last year. I think I covered that. I'm trying to think if I did an episode on that or if I covered it in the live. I think I just covered that in the live stream. I don't think I did an individual episode on that. But yeah, this is what I talked about with the maturity wall, with the fact that the extend and pretend was going to end, that lenders have basically come to the realization that, hey, this is probably about as low as rates are going to get. You might get a couple more rate cuts. It might drop down into the high 5s, but that's it. That is literally, I think that is as low as it's going to go. I really do not see it going much lower than that. And which is not bad. Having a rate at 5.5, 5.75%. That's not a bad, historically speaking, that is not a bad rate. That's still a pretty attractive interest rate. So nothing really wrong with that per se. And I think they've also come to the realization that hey, look, man, these rent rolls, the expenses, like the tenants, like some of this stuff, it's not it's not going to improve. It's either going to stay the same or it's just going to continue to get worse. So banks are basically saying, all right, time to pull the plug on some of this stuff. Now, here's the interesting though that I just like people to keep in mind. We're only talking about one segment of the commercial market. This is not 08, 09. This is not everything. It's not every segment of the market. We're not talking about industrial. We're not talking about retail properties. We're not talking about multifamily properties, even though there has been a little bit of an uptick in delinquency on multifamily recently. But not anything catastrophic happening in multifamily. Industrial's still very solid. Retail is still very solid. Mixed use is doing fine. Your specialty healthcare buildings and stuff like that, for the most part, are doing pretty good. So again, you're just talking about one segment of the commercial real estate market that's not doing good. So, like I said, just keep that in mind. Just keep that in mind. It's not not everything is deteriorating and blowing up. So, and then let's get into this first. So student loan delinquency rate jumps to nearly 25% in Trump's second term, and analysis finds. So nearly 25% of student loan borrowers with a payment due are now behind, compared with around 9% in 2019, according to a report published Friday by the Century Foundation, a left-leaning think tank. Around 7.9 million student loan borrowers entered delinquency in the first 3 quarters of 2025 alone. Student loan delinquency rates are especially high in red states, the analysis shows, and nearly 1 in 2 Black student loan borrowers are now behind on their payments. And I think what was interesting here is I believe there is a chart here at the bottom. Yes. So this chart here just kind of shows, where the student delinquency, 20% here, then 25, 30 is like dark blue, or over 30% is really dark blue. So again, you could see where's the really dark blue, like Nevada, Louisiana, Mississippi. Mississippi's 39%, Alabama's 34%, Georgia's 35%, South Carolina 31%, North Carolina 30%. Which in certain respects is kind of surprising, because those states have really seen a big boom in business. So you got to kind of wonder in some of those states, why is the hiring maybe not better, or what, maybe there seems to be a little bit of a disconnect there. But then you go up some of the northern states here, like Maine 17.9, Vermont 14%, New Hampshire 15%, Massachusetts 17.1. So again, it just, like I said, interesting chart here. Just interesting chart, kind of showing some of the different areas you see. Definitely in the south to the west, a little bit more in the delinquency, as opposed to the north part of the country, like the northern Midwest and the Northeast. So just interesting. Just like I said, just interesting to look at. So obviously, we will keep an eye on this throughout the rest of this year, to be sure. All right, the Fed minutes, and I know I'm kind of getting late on time here, so I don't have a whole lot of time here. So I'm going to because I do have some other banking news articles here I wanted to get to here. So the Fed minutes. So basically, just real quick here, Fed minutes show division as rate cuts remain on the table. So Federal Reserve officials signal that additional rate cuts are still possible this year, but January meeting minutes revealed growing concern about easing policy while inflation remains above 2%. With inflation near 2.5% and job growth mixed, the Fed appears firmly on hold for now, as it weighs persistent price pressures against moderating employment risks. And then I had, Fed dissent grows as some officials weigh return to interest rate hikes amid stubborn inflation. So several policymakers wanted language about potential rate increases in official announcement. The Fed meetings showed. And then we get into, minutes reveal Fed division over path of interest rates. The choice was between supporting the labor market and fighting inflation. So Federal Reserve officials were divided at last month's policy meeting over the path of interest rates, according to minutes released on February 18th. Although the Fed voted 10-2 to leave interest rates unchanged, Fed board members Christopher Waller and Stephen Murin preferred a quarter-point rate cut. Members expressed divergence on where the benchmark federal funds rate is headed. The division reflects that one side is continuing to fight inflation and the other to support the U.S. labor market. Several participants said that if inflation keeps inching closer to the institution's 2% target, it would be appropriate to support further downward adjustments. Other officials said that it would be best to keep interest rates intact for some time to examine incoming data. A number of these participants judged that additional policy easing may not be warranted until there was a clear indication that the progress of disinflation was firmly back on track. The minutes from the January 27, 28 meeting stated. So, have to keep an eye on this and see, what happens. But obviously, we're really getting into. I think we're really getting into a point where you're really beginning to see this divergence in factions at the Fed board, and I think you're starting to get these camps are starting to come out, which is, again, it's very interesting because Kevin Warsh, when he does get appointed here in the next couple of months, and as Jeremy Powell leaves, he's going to have his hands full. I mean, there's no doubt. I mean, he is definitely going to have his hands full with this one. So, all right, let's take a look at this for a second. So the Epstein fallout continues. Obviously, the big news that everybody heard was Prince Andrew getting arrested and then getting released by police. But he was basically, I believe, charged with giving a whole bunch of, basically state secrets to Epstein. Which was a big no-no. You can see here, this picture obviously got memed a lot this week. So that was one of the big things. Obviously, what's nice is that, the people in Europe seem to know how to arrest people over Epstein. It's just our Department of Justice doesn't seem to know how to arrest people over Epstein. Then we get, Epstein files fallout, the high-profile people burned by past dealings with the predator. The recent release by the Department of Justice of millions of pages of documents related to the notorious sex offender Jeffrey Epstein has led to a wave of resignations and other uncomfortable fallout for high-profile people around the world. Those affected include the top lawyer at the major investment bank Goldman Sachs, the CEO of Dubai's largest port, a former president of Harvard University, a former U.S. president, and an ex-secretary of state, and the chairman of a leading American corporate law firm. I like how they don't name the names there. I like how they don't say Bill Clinton, Hillary Clinton, Kathy Rumler. They don't mention any of these names. I like how they just give the titles. Being mentioned in the Epstein files does not mean that an individual is implicated in crimes. That is true. That is true. We do have to be very careful of guilt by association. Some people, didn't, just thought this guy was a high-profile financier, and and so but. A lot of these people did have really weird dealings with this guy. That is to be for sure. So, and then we get to Hyatt chairman Pritzker, part of the famous Pritzker family, leaves the board over his Epstein ties. So the Hyatt Hotel chairman, Thomas J. Pritzker, said he would retire in a letter to the chair's board. Pritzker, who has held the role for more than 2 decades, said he regretted maintaining contact with sex predator Jeffrey Epstein. Hyatt said its board appointed CEO Mark Hoplamazian to succeed Pritzker as the chair starting immediately. So, yes, so Thomas Pritzker right here. So obviously his... I'm not sure if that's his brother or if that's his cousin, who is the governor, Pritzker from Chicago. But then he's got, I'm just going to say this, Thomas Pritzker, that Pritzker family, they got a lot of weirdos in that family. I'm just going to say it that way. A lot of weirdos in that family, to be sure. A lot of weirdos there. So, but, no doubt with the arrest of Prince Andrew, Thomas Pritzker stepping down, again, just more fallout here. And I think just as people continue to comb through, again, remember, these are millions of documents. I think there was between like 3 and 6 million documents that got released. So people are going to be combing through these documents for months to come. So there's going to be a lot of stuff that there's a lot of stuff that's going to be coming out. And one thing I wouldn't be surprised to see is some people leaving to get ahead of some of this stuff. Like, in other words, if they know that, like, hey, I know I'm on the list, or this person knows they're on the list. They're like, yeah, let me get out of here before basically the hits the fan. So I wouldn't be surprised to see some of that too in the next next couple months or a month or so. Okay. Some articles here, some other bank news. So the Fed is going to consider changes in mortgage lending rules. So banks have basically lost their hold on mortgage origination in recent years to non-banks, like Rocket Mortgage. The Fed is looking at regulatory changes to bring mortgages back into the banking fold, according to Mickey Bowman. So banks are originating a smaller portion of mortgages than they used to, and the Federal Reserve wants to change that with proposed rule shifts, according to one top regulator. The Fed wants to make mortgage originations cheaper and more appealing to banks and is considering getting rid of the requirement to deduct mortgage servicing assets from regulatory capital while maintaining the 250% risk weight assigned to these assets. Vice Chair for Supervision Michelle Bowman said Monday at the American Bankers Association conference in Orlando, Florida. The central bank is also considering boosting the risk sensitivity of capital requirements for mortgage loans on bank books, she said, in part by using loan-to-value ratios to determine risk weight rather than applying for a uniform risk weight. The proposed changes will aid to encourage bank participation in mortgage servicing and would better align capital requirements with actual risk, Bowman said. So the Fed's upcoming proposals come amid what Bowman called a concerning trend. So in 2008, banks originated around 60% of mortgages and held the servicing rights on about 90% of mortgage balances, she said. Since that time, the contraction has been extraordinary. As of 2023, banks originated only 35% of mortgages and serviced about 45% of mortgage balances. If regulation, including the overcalibration of the capital treatment for mortgage origination, caused this shift, it's up to regulators to fix it, Bowman said. Yes. And I do believe that this capital treatment and this shift in regulation going back after 08, I think it was an overcorrection and has led to these results. So no doubt, changing some of this stuff up, or, revising some of this stuff will hopefully reverse a little bit of this trend and get some of these mortgages back into banks, which I think hopefully would be a good thing. All right, and then this guy, this clown. All right, so a whole bunch of drama here with this guy this week. So Mamdani, he proposes raising New York City property taxes if the state doesn't approve tax hikes on the wealthy, which is not going to happen. I knew this was going to, basically what's hysterical is the love affair with this nitwit. Basically went out there. I mean, this guy's only been in there for like 10 minutes and the love affair is already over. He's rushing right out there. We're going to tax this, that, and the other thing. And I love the thing that is so comical, and what happens every time with these clowns, every time, without fail, it always starts with, we're going to tax the rich, and then it immediately turns into, well, we're kind of going to tax the rich, but what we're really going to do is tax everybody else. Everybody else's taxes need to go up now, and not just this tax or that tax, all the taxes, everything just needs to go up, and everybody needs to pay for all the free stuff that I said I was going to give you that I'm not really going to give you now. It's just I'm amazed that honestly, I'm amazed that people fall for this nonsense. This is classic horrible politician behavior at its finest right here. It really is. Then you get, real estate expert blasts Mamdani's math-defying tax plan. He warns of higher rents in flight. Douglas Elliman agents say that the Democratic Socialist mayor's plan, and the other thing is, like, he's not a socialist, dude. He's a communist. Okay, could we just stop with the, they try to like downplay, like, oh, he's a socialist. No, he's not. He's a communist. Just say it. He's a communist. Mayor's plan could drive up rents and accelerate taxpayer flight to low tax states. Yes, absolutely. That is absolutely going to happen. I just did a whole episode on this if you want to see it. But that is absolutely what's going to happen. There's no doubt. And I'm about to give you here in a second. Here's a perfect example. What's this? Oh, Palantir is moving its headquarters from Denver to Miami. Palantir is moving its headquarters to Miami. The company previously moved from Palo Alto, California to Denver in 2020. Florida has seen a wave of billionaires in recent years, and several more have made the move since California began considering a 5% wealth tax on billionaires. So again, I did two episodes. I did an episode called basically, the flight of businesses out of Democrat-run cities. And then I basically did an episode called Is Florida and Texas Going to Become the New Wall Street? And I firmly believe that these trends are going to continue. And these are big trends. And, the Democrat-run cities are in a death spiral. They're in a total death spiral. They are going to continue to raise taxes, raise fees, bring people in that shouldn't be there. And and it's just going to the finances of these cities are already imploding, and they've got massive budget deficits. They're going to come back crying to the federal government, and the federal government is the federal government is tapped out. They're at a point, like I said, I've talked ad nauseum about the debt and how the debt needs to be cut. It needs to be reduced. I showed you all the five, going back to the five charts here in the article here at the very beginning. This projects the U.S. annual budget deficit will chop $3 trillion by fiscal year 2036. Well, yeah, a big part of that is those massive budget deficits being run in those Democrat cities and Democrat states. And they're gonna have to pay for this stuff at some point. The bill's gonna come due at some point. It just is. And then, interestingly, you got this, then you got the Ohio governor saying that they're talking about ending property taxes could push the state's sales tax up to 20%. So the Republican governor says sales tax could jump to 20% to replace the $24 billion in lost property tax revenue if constitutional amendment is passed. Florida, I don't have an article on this, but Florida is also talking about reducing or getting rid of part of the property tax. And again, this article is a little misleading because they're not talking about actual property, getting rid of all property taxes. They're talking about getting rid of a piece of the property tax. Because remember, you have the school taxes and then you have like the county and the state taxes. So they're talking about a part of the property tax, not the full property tax. So, and I have a lot of thoughts on that, but I'll save that for another night. So, all right. And then let's just talk about, so a legal battle over prediction markets is brewing. The CFTC fired it up today, baby. So a message Tuesday from CFTC chair Mike Selig prompted both fans and critics of prediction to sound off on the agencies defending the burgeoning business. The debate around which regulators have jurisdiction over prediction markets pivots around events, contracts related to sports events. So we saw that, and then we saw this. CFTC defends its right to prediction market enforcement as states challenge the platforms. So the Commodity Futures Trading Commission Chairman Michael Selig said the agency has filed an amicus brief in federal court to assert its authority over prediction market enforcement and regulation. The move comes just 3 weeks after Selig said he was prepared to draft new, clear rules to govern event contracts. Platforms like Kalshi and Polymarket are currently facing legal cases in multiple states over allegations that the platforms amount to little more than gambling. Yes, absolutely. And I absolutely believe that. I absolutely believe these platforms are just gambling. And they have used a legal loophole to get around it up to this point. They're getting around it up to this point because they are big business and they're spreading the dough around. So that's, but we'll keep it in. We'll keep an eye on this because I think this is going to heat up, and I do believe that this is going to become a bigger issue shortly here. So. Okay, and then finally, just a couple articles with some bank news. Wells Fargo CFO expects more layoffs after cutting tens of thousands of workers. So Wells Fargo CFO Mike Santomassimo said the bank will cut more staff and sell more real estate. The San Francisco bank has laid off about 70,000 employees since October of 2019. Wells Fargo is looking to shed additional real estate across the country. So again, the bigger banks right now, everybody is just on an efficiency mission. Efficiency, efficiency, efficiency. That's the word. Oh, sorry, I had one more article here. Basically, the sports betting and the zero-sum trap: how gambling drains wallets. This article is just all about gambling of young men. Sports betting has become an epidemic, especially among young men. The Guardian recently aggregated some alarming statistics about its prevalence. The story notes somewhere between 60 and 80% of high school students reported having gambled in the last year. The National Council on Problem Gambling reported in 2023. A study commissioned by the NCAA found that 58% of 18 to 22-year-olds had bet on sports, although it should be said that in most states this is illegal before the age of 21. But it's not stopping them because of DraftKings, FanDuel, prediction markets. These guys are making sure that these young kids are able to get on these platforms and gamble. You best believe that. Prediction markets have contributed to the normalization of gambling by blurring the line between investment and gambling. You can now essentially place betting parlays on Robinhood, an app previously dedicated to retail stock trading. In order to see why this uptake qualifies as an epidemic, we can use some economics to see how sports betting will necessarily make the average participant poorer. So then it gets into like investing versus gambling, points shaving, and efficient markets. But I'm gonna have to delve back into this article, and perhaps I'll save this again for next week, and I'll maybe come back to this and talk about this a little bit more in there. So, and then so JP Morgan Chase looking to open 160 branch openings this year. The largest U.S. lender flagged the Carolinas, Florida, Pennsylvania, Kansas, Massachusetts, and Tennessee as states where it's planned major expansion this year. OCC conditionally approves Stripe subsidiary Bridge for a trust charter. So the nod comes roughly 2 months after digital asset firms Circle, Ripple, and Paxos received a similar green light. Then we have here Gemini, CFO, COO, and CLO exit just months after the IPO. So a trio of executives are leaving about 5 months after the Winklevoss twins took the crypto exchange company public and within weeks of layoffs. So this isn't good. So the crypto exchange Gemini Space Station announced Tuesday it is parting ways with its CFO, COO, and CLO effective Tuesday, and expects to enter into separation agreements with potential eligibility for a limited period of time for the executives to provide additional transition services, according to a Tuesday securities filing. So not good there. Whatever is going on here doesn't look too hot at the moment. New Robinhood CFO takes seat amid a crypto winter. I talked about this in the crypto episode that I did, the installment I did on Monday. So the trading platform's newly appointed CFO, Shiv Verma, assured shareholders the company is long-term bullish on crypto while stressing ongoing product diversification. So good luck to the new CFO there. Goldman Sachs to drop DEI board standards as Trump's anti-woke campaign spreads across corporate America. So the Wall Street giant reportedly struck a deal with conservative nonprofit to remove other demographics language. So, and we've seen that going on through a bunch of different things. And then finally, kind of sad here, Wendy's to close hundreds of restaurants as company looks to focus on value to boost sales. So Wendy's interim CEO called 2026 a rebuilding year. So not very sad. I love Wendy's. I like Wendy's. I would say Chick-fil-A and Wendy's are probably my two favorite fast food places. So yeah, got to get your biggie bag, man. Got to get that biggie bag. All right. That being said, okay, I am going to go into wrap-up mode here. So let me jump into a couple of things. Let me find my banners here for a second. So I'm going to go through this, and then I'll do our story of the week and our quote of the week. So Let's see here. So if you are listening on Apple Podcast or Spotify, please make sure to leave me a review, as that would really, really help the channel. So if you're listening Apple Podcast or Spotify, please leave a review. Make sure to visit thebankernextdoor.com, as I have all the episodes and everything archived up on the website. So if you want to go and look for anything specific, you can find it. Everything's on there. A lot of articles, other interesting things out there on the website to check out. Make sure to subscribe on YouTube if you want the latest information on just what I have going on, episodes coming out, what I'm going to cover in the live stream, if there's a change to the time of the live stream, anything like that. You could check that out by subscribing on YouTube. Send comments, questions, or topic recommendations to info@thebankernextdoor.com. And then you can make sure you can follow me on social media. I'm up on Getter, X, and Truth Social, although I will tell you I spend probably the most of my time on X. Remember, BND Strategy Room is on YouTube, Rumble, and all major podcast platforms. You can follow me there, where I have new episodes every Monday through Friday coming out at noon. And then the BND Strategy Room is normally every Saturday night at 8 o'clock. I've had a little fluctuation because last few weeks because of kids and anniversaries and all kinds of other stuff. So yes, but usually try to get this in on Saturday nights at 8 o'clock is my usual time. So next week I should be back, no problem, Saturday night at 8 o'clock, and we can kind of go from there. But let me tee up my stuff here. So let's do our story of the week. So this week we're going to do bond. You know, what is a bond? Well, a bond is a fixed income instrument. It's been a long night already. Instrument that represents a loan made by an investor to a borrower, typically corporate or government. A bond could be thought of as an IOU between the lender and the borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds and debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner, and usually include the terms for variable or fixed rate or fixed interest payments made by the borrower. Bond prices are inversely correlated with interest rates. When rates go up, bond prices fall, and vice versa. So the appeal of this type of security is in the bondholder's ability to get back the entire principal of their investment, so long as the bond is held to maturity. Since bonds typically pay interest twice a year, they also serve as a reliable source of income. For these reasons, bonds provide a means of preserving capital while maintaining a stable investment. So there you have it, information on what a bond is. So, okay. And now our quote of the week. So this comes to us through Peter Bernstein. So, and I thought this was very apropos for all the things that happened today, by the way. So here we go. There is a tendency for people to expect the status quo either to last indefinitely or to provide advanced signals for shifting strategies. The world does not work like that. Surprise and shock are endemic to the system, and people should always arrange their affairs so they will survive such events. So I thought that was great. Basically, like, yeah, you know, people think the status quo of stuff is going to last forever, and it doesn't. And then they also expect well, hey, you'll give me some advance notice on that right before you change. No, usually not. Usually when things happen in the market, when things happen in the economy, sometimes things can change on a dime. And you just have to be prepared and be ready for that. And you'll be fine. You'll be able to survive such things in the future. So anyway, okay, with that being said, hey, I thank you so much for joining me tonight. I thank everybody for hanging out with me this evening. I just want to check if I have it. No comments there to address, but like I said, I thank you so much for hanging out with me tonight. I hope everyone has a great weekend out there. Keep an eye out for new episodes coming next week. Like I said, I should be back to the normal time at 8 o'clock on Saturday night next week. But again, thanks for hanging out. I hope everyone takes care, and I will see you again real soon. Thanks a lot, everybody.